What's up, you guys? I'm Dan, this is Frugal Not Cheap, and today we'll talk about what the heck happened with GameStop. Where to begin? A lot of the stories you may have seen in the media have focused on perhaps the most interesting and novel part of the saga in order to get clicks and views, which is of course the coordinated participation by retail investors. But I think, in order to make sense of this whole thing, it'll be much better to go in chronological order. And as we go along and learn about each of the different members in this cast of characters, I'll try to teach you a little something interesting about all of them. Because, well, there's plenty of wackiness all around. So I think the best place to begin is with GameStop itself. GameStop is a video game and console retailer, which also buys and sells secondhand items. It was doing well leading up to the 2009 financial crisis, and also doing fairly well, at least in terms of its stock price, as a rebound in the middle 2010s. But with the advent of and increasing market penetration of faster internet, very good internet speeds that we have today, sales of physical copies of video games have been falling very sharply relative to sales of digital copies. As an example of this, my own home computer now doesn't have a CD or DVD drive at all. All the media that I consume is all coming from the internet, downloading games via Steam, which is a very popular platform for digital copies of computer games. And when we look at overall game sales, we see that about 80% of them actually, so this is both PC and console, are now digital, with less than 20% of sales being physical copies. And when we look at just the console market, even there we're seeing things really shift, with the majority of sales now being digital and the minority of them being physical copies. In fact, the new PlayStation 5, there are two editions. One, which is $500, which has a physical disc drive, and then a digital edition that's $100 cheaper and priced to sell that has no physical media capability. So back to GameStop, we have an ailing business and also a failing business model. And enter today's first members in the cast of characters, which are hedge funds. What are hedge funds? Hedge funds are actively managed funds which seek to maximize investor returns and limit risk. The original hedge fund was launched by Alfred Winslow Jones, who, with $40,000 of his own money and $60,000 of investor money, set up the A.W. Jones & Company Fund in 1949. He tried to minimize the risk of holding long-term stock positions by short-selling other stocks. And with GameStop, short selling is exactly what hedge funds did over the past few years. Short selling is, in essence, making a bet that the price of a stock will fall. Technically, what happens is that you borrow a share from someone else and immediately sell it at the current market price. You're hoping that the price is going to fall, and so that if it does fall, then you'll be able to buy it cheaply and return the share that you borrowed and pocket the difference in the price. So for instance, if the price right now of stock XYZ is $100, I borrow one share, I sell it for $100, I've got my $100, and then if the price falls to, say, $50, then I can buy a share at $50, return it to whom I borrowed it from, and pocket the difference, less, of course, a little bit of interest that the share lender would have required me to pay. And they may also have asked me to put a little bit of money in an account as sort of a deposit or collateral to try to minimize the risk on this loan. But I would have gotten my margin or my collateral back at the end. So they would have pocketed whatever interest I might have had to pay. However, if the stock price, instead of falling to $50, jumped to $150, then I would now have to buy a $150 share to return, and I would lose $50 plus the interest. So short interest, which is the interest in having a short position, you might think of it that way. Basically, the number of short positions on GameStop, which goes by the stock ticker GME, rose sharply from about $20 million in 2017 to nearly $70 million by late 2019. In other words, hedge funds put on big bets that GME stock price would fall. Before I move on, I'd like to talk a little bit about hedge funds and give you one of those interesting bits of color to our first member in the cast of characters, as we'll be doing with the others. So here's something that I think is really interesting about them. Hedge funds are known as being the smart money, where these very, very well compensated fund managers are out there getting these amazing returns for their investors. But something that the sort of everyday person doesn't necessarily know is, well, a couple of interesting facts. First is what's called 2 and 20. So this is the fee structure for hedge funds, and it is, well, it's pretty brutal. So the 2 of the 2 and 20 is 2%. Which is 2% of assets under management. For every $100 that you invest in the hedge fund, they would take $2 a year as their fee, right? Then the 20% is the 20% of profits. So of any profits that you made in the fund in a given year, then they would take 20% of that as their performance fee, and you'd be left with only 80% of your profits. But of course, this isn't symmetric, so if the fund had lost money in that year, they wouldn't compensate you in any way at all. So no matter what, as the hedge fund owner, right, the person that's running the hedge fund, you get 2% of all the money that you convince people to put with you. You get 20% of any gains that they make, but you don't suffer any of their losses. So it's a pretty sweet deal for the hedge fund manager. Now, this wouldn't be so bad for the investor as long as those returns that you got to keep 80% of were huge, right? And really, really beating the market. But the problem is they don't seem to be able to do that consistently. That's a theme that we've talked about a lot on this channel. And I'll mention again a famous bet between Warren Buffett and hedge fund managers saying that the S&P 500 index, just an index of the 500 largest US companies, would outperform any hedge funds after fees. So there's a famous bet made with Protégé, a hedge fund, and its co-founder. And between 2008 and 2016, the S&P 500 index handily outperformed the hedge fund and the fund of funds, which was just kind of like a conglomeration of a number of different hedge funds that were put together in order to try to increase the chances of the hedge funds winning and be more representative of the overall hedge fund pool. On average, these funds returned just 22% compared to over 80% for the S&P 500 over that period. So investors did get savvy to this, and in 2016, they withdrew over $94 billion from hedge funds. And in response, the industry did change a little bit, and they've reduced fees. So the average management fee has fallen to about 1.6% rather than 2%, and the average performance fee has been dropped down to around 17% instead of 20%. But they're still fairly substantial, as you can see. So hopefully you can see why, at least to me anyway, it looks pretty attractive to be a hedge fund manager, but not all that awesome to be a hedge fund investor. In fact, talking about the returns over the period during which he'd made his bet, Warren Buffett said that for investors, the returns were dismal. Really dismal. Anyway, so these hedge funds placed big bets that the GameStop price would fall. Not everybody thought that the GameStop stock was overvalued, however. Now, Michael Burry, who's one of the famous Big Shorts from the 2009 financial crisis, if you haven't seen the movie The Big Short, I highly recommend it. It is amazing, and you'll learn quite a lot. So Michael Burry bought up a bunch of GameStop stock. It became the largest position in his Scion asset management portfolio by late 2019. By buying it, he was taking what we call a long position, which is a bet that the price will increase. As of the end of September 2020, that was a position of over $550 million worth of stock. Then Ryan Cohen, founder of e-commerce pet site Chewy, took up a very large position in GameStop, buying 9 million shares in order to try to have some decision-making power and pressure them to basically revamp their business model. Of course, he's an e-commerce retailer, and so he's looking at helping push GameStop into a digital sales model. So there is kind of a turnaround plan in place for GameStop. We'll see if it's going to work or not. And the company does still have a lot of assets, so it should not be worth zero. But so far, nothing really interesting or particularly new has happened in the story. We just have a business that wasn't doing very well, hedge funds have shorted it, and there are other people that are trying to turn the company around or think that the stock was undervalued. Enter Wall Street Bets. Wall Street Bets is a subreddit that's full of memes, very interesting, and a ton of people who are speculating on the stock market. There's a number of reckless players talking about things like putting all of their Roth IRA retirement assets into a highly speculative day trading play. This kind of thing is common. In my personal view, it's full of a ton of YOLO gamblers that make up some larger percentage of the subreddit membership, and then there are also a small percentage of very sharp, very astute, and very knowledgeable traders. Now, I'm not subscribed to the Wall Street Bets subreddit, so I haven't followed this saga from its inception. I tried to find out who was behind making this GME long play very popular in the subreddit, and I couldn't really find anything in a cursory search. Maybe more will be revealed in the future. The only thing I could find was about a guy named Keith Gill, who took a decent position in the stock, a long play, back in the summer of 2019, which is kind of similar timing to what Michael Burry did. Anyway, somehow the long GME play became very popular amongst the Wall Street Bets subreddit. Whether this occurred organically or if some of these very sharp people that I believe exist out there somehow were able to make a strong case for what was going to happen and get people on board, which then kind of becomes a self-fulfilling prophecy. I'm not sure if that's the case. I don't know how it happened. But what I do know is that some people who got in early and were able to ride the wave up and get the timing right stood to profit a whole heck of a lot. Another thing that I do know is kind of a strange thing about social media is that if you're able to, like I talked about this self-fulfilling prophecy, have a large audience for your views, and you kind of not necessarily recommend something, because a lot of these people are very sharp to toe the line to toe the line so that they're not kind of crossing any legal boundaries. But anyway, if you can get a lot of people to think that a certain investment is a good idea, then they'll jump on it, and then the price will appreciate, and you'll be able to make some money off of it. In fact, this is something that appears to be fairly common in the very opaque crypto space. So I'd recommend to check out a video by Coffeezilla, where he interviewed someone that was in the crypto space and had found that just having his YouTube channel, he was able to have power to actually move the market price by getting people to change their behavior. So it's pretty crazy. Check it out in the description below. So with GME, this could have happened. I don't know. What we do know is that the stock price spiked very, very sharply. So what caused this huge spike in GME prices that allowed the people that were long the stock to profit handsomely? This was what we call a short squeeze. Remember when we talked about the short sale that we had to borrow the share that we would then sell immediately and then have to buy back later? And we also talked about how we have to put up some collateral, some money in our margin account in order to secure this loan or this position. Now, as the price goes up and our bet that prices would fall starts to look more and more wrong, the amount of collateral that we're asked to put up increases. And if our margin call, the amount of collateral that we're asked to put into the account, gets to be so big that we can't afford it, then we'll be forced to cover our position and exit it. In other words, we'll have to realize the loss by buying the share at a higher price in order to return it, and we'll have actually realized this significant loss. So in other words, we are squeezed to exit our short position. Knowing this, people bid up the price of GME by buying the stock, or in other ways we'll talk about later. They push that stock price up, knowing that collateral obligations for the hedge funds would increase, and a lot of them would be forced to cover. In order to cover, as we said, they'd have to go out and buy shares, which would bid up the price even further, so it becomes kind of a cycle. But that's not all. There was also what we call a gamma squeeze. I have a video coming up that will teach you the basics about options, and we'll cover gamma there in more detail. But for now, we'll do something quick and dirty and say this. First, a lot of Wall Street Bets players didn't own the stock outright. And I imagine that the most astute players who got in right as the squeeze was happening employed the following strategy, which was to buy call options. With a call option, you essentially pay a premium that then gives you the right to buy the stock price at the current market price if the price goes up. In other words, you put a little bit of money down and you get the right to take a long bet on the stock without having to put in all the money in order to buy the stock, because the premium is just a fraction of the share price. So if the price does go up, then you get to pocket the difference between the price that you set the bet at, called the strike price, and the current market price. You pocket that. But of course you lost the premium, so that's going to eat into your profits a little bit. If you're wrong about the bet and prices fall, then the good part is that all that happens is you lost your premium that you used to place the bet, and that's it. It doesn't matter about the price falling on the asset for you. So for a relatively small amount of capital, Redditors were able to place long bets on GME using these call options. But of course, someone had to take the other side of the trade. These people were buying call options from someone who was selling or writing these call options. And these option writers, they earned the premium, right, that was paid up front. But if the bet went against them and the prices rose, then they would be forced to pay the difference in the strike price and the current market price. And as the price went up and the trading position of these option writers went increasingly negative, they were also asked to put more margin in as collateral on the position. So they faced these big margin calls in order to satisfy the risk departments of their brokers. And in turn, once they got to places where they could no longer afford these margin calls, or they just decided to give up on the position and limit their losses, they were forced to cover. They also got squeezed in what we call the gamma squeeze. And to add to all this trouble, whereas you can have a short position on a stock in a short sale for an indefinite period of time, there's generally no time requirement. Call options have an expiration date. And so depending on which expiration they were selling these calls for, there was a limited amount of time that they had before they would be forced to realize this loss. So they were squeezed not only on margin, but also on time, and a lot of these traders had to close out or cover their positions by buying GME stock, thereby bidding the price up even further. Now, the platform on which much of this trading by the Wall Street Bets subreddit people occurred on is a platform called Robinhood. This is the next player in our cast of characters. In my view, one of the reasons for the popularity of the Wall Street Bets subreddit and the varying levels of sophistication that you'll see amongst its subreddit members and traders is that Robinhood helped popularize stock trading, day trading really, and options trading as well. And the way that Robinhood did this is by providing zero commission trades. So in the past, there were always transaction costs, there were commissions. A lot of times you had to have a broker and call them on their phone, on the phone in the old days and that kind of thing. So there were some barriers to entry for your run-of-the-mill sort of everyday person to engage in stock options trading. But Robinhood, by offering commission-free trades, really reduced these barriers and made it much more popular for people who want to do it. On top of that also was the interface. So rather than calling this broker up, you have a very modern, sleek, intuitive interface that's right there on an app in your phone. But Robinhood is super slick marketing. How could they offer commission-free trades? If you're not paying them as the customer, then who is the customer? Or, as others have put it, if you're getting a free service, then you're not the customer, you are the product. This is as true for Google services, where they train their algorithms using your behavior, or Facebook, where they use your data in order to target ads at you that they can then generate more ad revenue by. It is as true for those guys as it is for Robinhood and its ilk. How exactly does Robinhood make money? Well, it makes some money. There's a $5 membership fee for what they call its gold membership, which is a subscription service that allows you access to margin loans and some other trading strategies and stuff. And of course, those margin loans are another source of revenue. But the big revenues come from lending out your shares to others who are engaging in short selling. They do that. You don't get the interest they do. And then the other part, the big one, is paying for order flow. They get paid to send your order to a market maker who's then able, knowing what your trade is going to be, in order to run your position and make a small spread on each and every trade. If you want to learn more about this, I highly recommend the book Flash Boys by Michael Lewis. He's the same author who wrote The Big Short. Really, really good stuff, and it might give you a reason to support the IEX exchange. Now, who are these market makers that are paying Robinhood for order flow? You guessed it, hedge funds like Citadel. And this was the business model from the beginning. So maybe now you can see what I meant by slick marketing. And this is why there's sort of a populist view to the GameStop short squeeze, because what you have is what it looks like is a bunch of retail investors, little guys that are bloodying the nose of these fat cat hedge fund guys. But part of the irony of it is that they're doing it on a platform that's in large part owned by one of the fat cat hedge funds. And they're also, actually, all of their orders are being routed to them. And so they're making a tiny little bit off of each and every one of these trades. And on the other side, the so-called little guy investor, side, there are those people who are able to get in early or have the right timing and ride the wave up. But for each one of the very few of those, there may be many others who have come in late to the party and who are being convinced to hold on to their short position through a meme called Diamond Fingers. Anyway, they're being convinced to hold on to their position no matter what, and they may well lose their shirts if the price comes back down. And there is good reason to think the GameStop stock price may come down, in my view. The current valuation is way beyond its previous peak. So we'll see. I hope you found this helpful. If you did, hit the like button. If you'd like to see more videos like this, hit the subscribe button. If you'd like YouTube to let you know when new videos are posted, ring the notification bell icon. All that stuff. Anyway, thanks for watching. Hope you enjoyed it. Hope you found it interesting, and I'll see you in the next video.